Hi, everyone. Good morning. I'm Michael Episcope, co-CEO and co-founder of Origin. This is the IncomePlus Fund webinar. And joining me today from Charlotte is Dave Welk, Managing Director of Acquisitions. And Dave has been with Origin for almost 12 years. He just reminded me his anniversary is coming up, and he and I actually met in graduate school around 14 years ago. And he was definitely the shining star of the program. I was kind of the old man in class. I was 36 years of age, and I was in class with a bunch of kind of mid-20s. And so somehow we convinced Dave to join Origin when it was in its infancy, and the rest is sort of history. Dave oversees the team responsible for sourcing all of our common equity deals, including development, and has an incredible nose for good deals. So we're glad that he calls Origin home. Welcome, Dave.
Thanks, Michael. It's been a great almost a decade and a half with you. So pleasure to be on this morning.
Yeah, I was just doing the math. I've known you for half of a quarter of a century. It's a long time. The webinar is going to be about an hour in length, with the first 35 to 40 minutes dedicated to the presentation, and the last 20 minutes for Q&A. Like always, enter your questions in the question and answer box, not in the chat box. We're not going to look at that. And we'll also cover the questions that were emailed in advance. I'm going to start by covering the macro environment. I'm going to go over the fund overview and then dive into the portfolio valuation. Dave is going to talk about our investment management capabilities, go over a few deals, the pipeline, and then provide some details on one of our upcoming Sidecar opportunities, and then we will open it up for Q&A after that. So a lot to cover today. Just to kind of set the table for the webinar, we've been preaching the value of being a defensive investor for the last 2+ years. During the run-up in 2021, cap rates were below 3.5%. In some markets, they were 3%. Asset values were trading 30 to 50% above replacement cost. And we decided to kind of step to the side and not participate in that market. And so we haven't bought a single asset since March of 2020. We've only invested in preferred equity and ground up development. And that's what you're going to see when we talk about the portfolio makeup in this fund, how it's dominated by those two asset classes. And this is really why we've been able to generate positive returns in an awful market. And we get a lot of questions about this. Certainly they're valid, right? How have you been able to write up the fund and generate positive returns in a year like 2022 and even 2023, the early days? And the answer is because a lot of this fund, it's not in traditional multifamily and common equity as in other funds. And so we're going to go into a lot of that in more detail. But certainly we're not immune to the laws of finance. We have adjusted value. We've written things down significantly in our fund, but writing things down from a terminal value perspective is different than writing down our current investment. I'll talk more about that when I go into the ground up development. The advantage of this fund is it has complementary strategies, and we have the ability to direct capital towards where we see the highest risk-adjusted returns and away from the areas that have asymmetric returns to the downside. So 2023, it's likely going to be a tough year in real estate, but also a great environment for investing. Let's jump into the presentation. Bring up the slides here. We'll start with state of the market, as we've always done. The biggest issue we're facing today is really in the lending market. You have both high borrowing costs and tight credit. First Republic just reported that $100 billion of deposits flowed out of the bank, and it looks like that's the next bank to fail. I think we were all hoping that this would be behind us, but the banking crisis, it's still unfolding as we sit here today. And money, unfortunately, is now concentrated in the 5 largest banks, and that's a problem because it's the regional and the community banks that provide the bulk of lending for real estate, especially on the construction side. But it's also an opportunity for private capital to step in, and there's a tremendous amount of dry powder out there. There's plenty of liquidity. We think that will happen in this environment, and certainly that's what we're going to be doing in this fund as well. What is interesting, and the good news about, if there is a silver lining to this, is the banking crisis. It really has nothing to do with bad loans, very different than it was in 2008. it's really isolated to the balance sheet of banks. So we're not going to see assets sell for pennies on the dollars, but certainly it's going to lead to maybe deteriorating fundamentals, because credit is what drives any market. It's credit availability. It's going to be difficult to acquire new properties for people. I think for sponsors out there, you're going to see the new loan to cost at probably 55, maybe even 60%. And these are going to be on the higher quality assets, cash flowing. I think anything left of center is not going to get capitalized. And then, the refinancing of existing properties, that's going to be what we call the new kind of cash in refinance, where sponsors are going to have to bring quite a bit of money to the table. Now, the advantage multifamily real estate has in a tight lending environment is access to government-sponsored entities. Freddie Mac, Fannie Mae, they accounted for more than $120 billion of loan volume last year. And on top of that, you also have HUD debt too. So it's an advantage that multifamily has over other asset classes, and a little bit more why we're insulated in that particular manner. Now, the silver lining here might be that we're not going to continue to see the Fed continuing on their tightening spree. Many are now predicting lower rates by the end of the year. We've actually had some generally positive news about inflation, neutral, if anything. And so the 10-year has come off its highs, 80 basis points. We haven't seen nearly as much volatility. It sits at around 3.4% today. So it's nice to see it stabilizing, finding its footing, but it's still high though, and certainly much higher than where we need it to be in multifamily, because borrowing costs, if you tag on another 150 basis points, 160 basis points, the spread between the 10-year and where you can borrow long-term in multifamily real estate, you're talking about 5% borrowing costs. And cap rates are still in the 4.5% range. So you have negative carry. And what that means is that every dollar of debt you use on an acquisition, it actually hurts returns. So it's not a good formula for success right now. And that's why we're not really looking at any new deals, and really until we see this equation flip. And it will, and it always does. The market has a way of self-correcting. But this is really, like, to us, it's the kind of environment that leads to incredible investing opportunities, because you have some near-term dislocation with good long-term fundamental opportunities. Let's go to the next slide, please. So what you see in front of you is the opportunity. This is loan to value by vintage. And you can see on the right-hand side, the 2021 vintage is already above 90% loan to value. And by all measures, that should make sense. Multifamily real estate is down 15 to 20%, which wipes out equity first. So if you leveraged at 65 to 70% and your assets down 20%, that's how you get to sort of that 90% LTV. The other vintages are generally healthy. They, that should make sense also, because if you refinance the deal in 2019 or early 2020, then you've seen a lot of appreciation. So in those vintages, you've actually worked your way into a lower loan to value situation. Now, the likely outcome here for the 2021 vintage, and there was a lot of volume that happened, is that there will be a big opportunity for gap and rescue equity as these sponsors look to refinance. 2023 and 2024 are going to be the years for the cash in refinance. Developers for years, since 2009, 10, 11, they've been used to the cash out refinance, taking out 50, 60, 80, even 100% of their equity when they go and refinance a loan. But it's really flipped quite a bit. And we're seeing, even in today's market, where banks are requiring, they're going to a lower loan to value. And it's very likely that even if you're refinancing today in a property that was priced in 2020, you still have to bring $10, $15 million to the table. So those 2021 vintage properties, you're going to see them needing 20, 30, even $40 million to pay down the senior loan. And if they have preferred equity or mezz debt on that, that's going to even be more painful for them. So, but that's really the opportunity and where we will step in this fund. Risk is being rewarded. Once again, we've talked about this on our previous webinars. Preferred equity terms have gone from 12 to 14%. They've gone from 85% in the capital stack down to 80 and even 75%. So you're actually getting paid more to be in a safer position. And the nice thing about an environment where capital now has the leverage is that we're going to be able to name our terms. And the reason I alluded to this earlier, why we think this is an opportunity versus catching a falling knife, is that the long-term fundamentals are strong. Next slide, please. So if this were office, I would tell you this is be a value trap. There's no bottom to office right now, and the fundamentals are terrible. The chart in front of you is a great visual that illustrates why there is a housing shortage in this country. We've been undersupplied for the last 12, 13, even 14 years, and that shortage is estimated to be somewhere between 3.5 and 4 million units. Now, there's a lot of supply coming. There are over 1 million units on the multifamily side coming to market over the next kind of 18 months. So that's, I would say the supply is about 40 to 50% greater than it is historically being delivered. But we also had a period in 2020 where nothing got off the ground. So a lot of pent-up demand here. And supply is going to outpace demand, but it doesn't begin to cure the problem. 3.5 million minus 1, you still have a housing shortage. And the other thing that's kind of exacerbating the situation is the last 9 months, we really haven't seen any housing starts because of the interest rate environment. It's put a halt on new housing starts in both the multifamily and for sale side. Mortgage rates are 7%. Borrowing costs for multifamily don't make sense. And so after we see this kind of near-term supply get absorbed, there's nothing behind it. In fact, you have this sort of other situation where you have no supply. And so what we see is a near-term supply issue, loans out of balance, and recovering fundamentals. And that's why we see this as a great investment opportunity over the next 6 to 18 months. There's going to be another leg up in multifamily, call it at the end of 2024, beginning of 2025 during that period. So let's jump into the next slide. I'll just go over the portfolio briefly. This is a supplemental update. So these are meant for existing investors. Certainly there's a lot of prospective investors on this webinar as well. So I'll just cover this quickly. The fund is designed to deliver stable, tax-efficient returns. The last 12 months, we've generated close to around a 10% return, net return to investors. 47 out of 48 months that the fund's been around, they've been positive returns. The only time we've lost money was in April of 2020 during that COVID month. The net asset value of the fund stands a little bit more than $400 million, and the net asset value on a per unit basis is $11.43. And what that means is that if you buy into the fund today, that's the price that you'll be paying for your units. Distribution yield is 5.8%. So that is paid monthly, and the distribution yield is only part of the return. The other part of this return is appreciation. And so our goal is to increase the net asset value per unit by about 3 to 5% per year and deliver another 5 to 6% in income. And if you don't need the income, you can opt into the DRIP. About 63% of our investors are actually in the distribution reinvestment program, and that creates more of a value-added profile. And I do want to remind you, we've increased the distribution yield each year. We did it again this year. That's our goal, is to continue to, kind of target that 6% yield going forward. So in the future, if the NAV per unit gets up to $15, then we'll also increase the distribution yield so we can always kind of maintain that leverage. It's going to be dependent on market conditions as well. Funds leverage extremely low at 48%. I'll get into that in a second. If you look on the left-hand side, You can see the makeup of the fund. Core plus assets make up around 19%, ground up development, 15%, public REITs, 4%. We have cash on hand of around 6%, and then preferred equity makes up the bulk of the portfolio at 56%. So I'm going to jump in to the portfolio on an asset by asset in a second. But if you're in an open-ended fund or considering buying into one, really the most important question you can ask is what assets are in the fund and how are they being valued? And we get this question quite a bit. So this next slide that I'm going to talk about is the analysis of our ground up developments. Our assets here, they're being, you can see these are 5 assets that are in the fund right now at some various stages of construction. They're being valued at a terminal value of 4.75%. Again, cap rates today are closer to 4.5%, but we drift them higher through time to account for the unknown. This is just good institutional practices. We actually had an advisor ask us the other day for one of the first times. He said, "Hey, do you guys show cap rates the same or lower in any of your models in the future?" And we said, "Absolutely not." And it's a really good question, because any model will work if you look at existing cap rates today and you're forecasting lower cap rates in the future. But the reality is that for what's unknown and the risk, you have to protect yourself against that. And one of the ways you do it with cap rates is by expanding them into the future. The fund equity, we've invested around $60 million into these 5 deals. And so you can see the pro forma value of these investments at stabilization was $111 million when we broke ground. That has since been revised to $92 million. And so we've actually written down our investments by close to $20 million. And it's important because, going back to what I said earlier, we're not immune to the laws of finance. When cap rates go from 3.5% to 4.5%, we are impacted as well. The difference is that we have written down a theoretical profit rather than our actual investment itself. Had we put $60 million into value added or core plus assets, we would have been writing down our investment. This illustrates exactly what we've been talking about for 2+ years, why we favor development over buying existing assets, because it's that margin that we're developing to. And if we can develop a property for $300,000 per unit into a market where values are trading at $400,000, well, if values go down to $350,000, all we've done is given a profit. We haven't lost money. But if you buy an asset at $400,000 per unit, and it goes down to $350,000, well, then you're in the exact same place where everybody else is from that 2021 vintage, from that slide or a few slides back that I showed. And that's really what has happened here, is we've seen a deterioration of around $20 million in profit, but not a write-down. And this next slide that I'm going to show you kind of highlights our valuation policy. And so this slide is actually taken from our valuation policy manual. I added that lower line that you see there, but the blue line going from left to right, that represents the percentage of the terminal value profit we book at each point in time. The cash flow is discounted back at every point in time to come up with a present value. Value creation, it doesn't happen all at once. And in an open-ended fund, we have to value the fund monthly. And for example, just to make this simple, if a property is expected to generate a profit of $30 million at the end of stabilization, that's usually in about 3 years, and we are 50% complete with construction, we will book 39% of that profit. That's what you see, that vertical blue line. I put it there because it's a little hard to read this font. They're small. But if you look to the right now, to the diagonal blue line, you see that the $111 million, that was the pro forma value. And that's the slope that we started on. The orange line represents the revaluation of that $92 million. So even though we've revised the end result downwards by close to 20 million, we aren't taking a loss against equity or marking the fund down. We've just changed the slope for how we are valuing and booking that profit in the fund. And there's a good chance that if rates come down and cap rates follow, we might even make up some of that gap between 87 or 92 million and $111 million. This is an iterative process, and it's done monthly. And certainly the capital markets are in a terrible shape right now. And this valuation represents the current state of the market. Let's go to our next slide. So this is the Core Plus portfolio, and this only makes up around 19% of the portfolio today. We have 3 stabilized deals, and these provide cash flow, depreciation, and appreciation to the fund. And arguably, this is the riskiest part of the portfolio because it's the most susceptible to a rise in cap rates. And we have taken a write down on these over the last, I would say, year and a half. But the ground up development write ups have more than been able to offset that, plus the interest that we're making on our preferred equity as well. But we didn't, with these, we didn't write them up nearly as much as we could have during 2021. We ignored many of the outliers. And when you don't write things up, you don't have to write them down nearly as much. And I would say valuing assets, it's part art and part science. And just because you have these outliers that are crazy doesn't mean, there's no benefit to us to write the fund up to these insane values and then just have to write them down later. Ultimately, the 5 deals you saw under the development slide, they will end up going into this bucket once they go into lease up. That's kind of how they transition. We don't sell. This is our build to core strategy. And then what we will do is refill that development bucket with new opportunities, because that's really our high margin bucket. And that's how we get to the kind of core plus opportunities. The right-hand side, I think, is what matters most if you're considering this fund or if you're in this fund, and those are the cap rates we're carrying these assets at. I would say that these are fair to conservative based on the limited trades we've seen in the market. You also have to be careful with cap rates. There is a triangulation between cap rates, replacement costs, where current values are trading. We're just showing cap rates here to be, for simplicity's sake, but there's a lot that goes on behind the scenes to come up with these valuation levels. I mentioned this early on the overview, but the fund level LTV is 48%, and that's really because of the appreciation that these assets have experienced over the last couple of years. It's driven down the loan to value. I'm going to jump into my last slide here, which is an evaluation of the preferred equity portfolio. This is the bulk of our portfolio, makes up 56% of the portfolio. This is where a significant amount of our investment activities, have been over the last 2 years. Now, you can see on the far right the current loan to value of each investment based on valuing the asset at a 4.75% cap rate. Again, 4.75%, it's a little aggressive. This would look different at 4.5%. But we wanted to really illustrate how we look at risk, how we evaluate these things. And certainly these aren't being paid off today. So we're looking, kind of in the future, what would happen if? That's a question we ask ourselves constantly. The assets in red, and you may not be able to tell, there's one below in orange, it might look red, but those are on our watch list. But I do, again, back to loan to value, evaluating risk, it goes well beyond loan to value. There's sponsor, there's location, there's replacement cost, there's market fundamentals, there's idiosyncratic issues that you want to evaluate. And I'll give you an example, like White Oak in Houston, that's the one at the very top that says it's a 96% loan to value. Now, this is a QZ opportunity. It's in Houston. And the investor here is a well-capitalized family office. Our basis is $215,000 per unit. To build this today would be $260,000, $270,000, $280,000. So we're well below replacement cost. And I really don't think they're going to let this deal go and lose their QOZ benefits, because they are looking at this as a long-term investment, 10, 15, 20, 25 years. And when we were evaluating this deal, that is one thing that got us comfortable from the beginning, is the wherewithal of the sponsor and the fact that they're looking at this. They're not a merchant build. They're not, a sponsor who, might walk away. They want those tax benefits and see this as a market where they're going to make their money over the next 10 to 20 years. And you also have to keep in mind that these are our internal numbers. Their numbers are likely much different. They might be valuing this asset at $300,000 per unit. PDG Central Park, this is located in Denver. It's a fantastic location. This one is also 96% loan to value in our numbers. And it's well below replacement cost. We'd love to own this asset at this basis, but it's not likely. We're not seeing assets trade at this level. Comparable properties are trading significantly higher than where we have this asset currently valued. But again, evaluating risk, this is how we look at it. It's on our watch list, but it's not impaired in any means right now. Goodwin Apartments is the next one. That one's kind of orange, floating towards red. That's 93% loan to value. And that again, like the first one, that's a QOZ deal. So that money has a very long-term perspective. This is located in Austin, Texas. Nearby properties, comparables are trading for $340, $350 a door. Our basis is at $252,000 a door. But, candidly, there haven't been a lot of transactions. So we're triangulating using this more math and looking at where we can sell this in the market today, and then looking at actually where they can likely refinance this and take us out as well. So there is, a lot of things that go into this. If we use the comparable sales, though, the right-hand column would look very different than it does now. The LTVs would be significantly lower. Certainly when we're evaluating equity, we triangulate all these things together. The other thing I really want to point out here is our terms, right? They put us in the driver's seat. So the sponsors, they are required to pay us down when they refinance these assets, or we can trigger our rights to step in or even force a sale of the asset. And the last thing, I was talking about valuation earlier. When it comes to valuing assets like these, we actually do two things. So we stop accruing interest at the fund level. Certainly the sponsor is still on the hook to pay that interest. If it warrants, we do that. And then we will take a loss reserve against the investment if it warrants that as well. And those are highlighted in our valuation policy. But those are some of the ways that if you're getting into this fund, we're not just accruing these things up over 100%. In fact, in the top two and in the other one, we've stopped accruing interest. We stopped a while ago, but this represents our full accrual basis based on what the sponsor owes us. Now, the last thing I'll say is that I'm highlighting the riskier deals here, but the reality is that almost all of our deals are in the green. We have deals that are on the opposite end of the spectrum too. Our lively deals, they're actually stabilized and cash flowing, and we sit below 70% loan to value, and we accrue interest at a rate of 13%. We don't write those up on that side. We don't value. Those tend to have near short-term maturities, but we will write assets down if they warrant it. So to me, that's an outsized return for that position in a cash flowing asset. And we have far more deals that look like that than are on our watch list. So I would say overall, the portfolio is in a really great position today. We're happy with the preferred equity where it's trading. We're looking at more deals out there. Dave's going to talk about that in a second here. So I'm going to hand it over to him. And once he's done, we'll open it up for Q&A. Dave?
Thank you, Michael, and thanks again for the kind opening remarks. Just realizing now that it's actually been a few months since I've had the opportunity to join the IncomePlus Fund webinar. So I think it was actually last fall was the last time that I was on. And as Michael covered in great detail, there's been some significant changes in the capital markets since then, and we'll highlight some of those and some of the measures that we're taking as an active investment manager to help mitigate some of this risk. And to that end, I'd like to highlight a little bit about some of our recent achievements that recognizes our efforts as an active investment manager. Origin placed third out of 68 operators. So that was a little over 1,600 properties that were part of the overall survey that was taken, placed third in terms of reputation management, performance, and fourth for best maintenance in 2022 among the Resident Choice Awards on the Opinion platform. And these awards were designated to recognize the achievement of providing best-in-class resident experiences, and were only offered to 10% of the nation's operators. Additionally, 2 of Origin's properties were recognized for placing within the top 10% on the individual property ratings as well, including this resident choice survey. So very proud of those results. Our active investment management efforts, including using opinion as a tool, resulted in 23% improvement across our portfolio in our Google score over the past year. And this is an important leading indicator that is used by a growing segment of the renter population. When they go out and search for apartments, oftentimes they're first going to Google reviews or various search review scores to determine their kind of initial starting place for searching for a prospective residence. So very happy about that, and proud to give an acknowledgement to our investment management team on that award. On the next slide, we'll talk about one of the build-to-core assets in our portfolio. Michael mentioned previously during his presentation that as these projects move throughout the development life cycle, they eventually move into our core portfolio. This investment, Linden House, is part of that build-to-core bucket. So I'll provide a few project updates, and then I'll highlight a little bit about the technology, one of the technology tools that our investment management team uses to keep track of our growing development portfolio. But over the quarter at Linden House, construction progressed along the schedule. We're still in a good spot to deliver units in the first units in the end of the second quarter. We'll be delivering about 143 of the units in the first section of buildings that we're delivering over the quarter. And right now we're working on installation of cabinetry and countertops, flooring, plumbing and light fixtures, and shower case enclosures. So a lot of the elements of the unit are really starting to come to life. And then over the coming months, we'll be continuing to work on interior finishes, with the millwork and appliance installation, finishing up the paint, cleaning those units out, and preparing them for our first residents. We're also working on the clubhouse completion of amenity spaces, which is critically important as you're showing prospects to the community to make sure that that clubhouse and the amenity space that is really part of the marketing of the investment to the prospective renter is completed. Working on completion of that, along with 78 units that'll roughly deliver about a month behind those 143 units I just mentioned. Those will be delivering in rough timeline in early August. So overall, the project's about at the end of the first quarter is 70% complete. So moving through and excited, frankly, the way this project's taking shape. I was down there in Jacksonville in the end of January and had the opportunity to actually tour the site, and it's moved along quite well. We did select our property manager here after interviewing 3 different firms. We elected to bring on our vertically integrated partner, a group called Rise, who we have a lot of development activity going in not only the Jacksonville market, but also throughout Florida as well. We've selected their property management team, and we have selected a branding for the project as well. Going forward, this will no longer be called Linden House. This will be Rise Bartram Park, which is an acknowledgement to the neighborhood that the project lies in. And then also we're taking advantage of the Rise brand that they've developed and is well regarded throughout Jacksonville. So it'll be called Rise Bartram Park going forward. On the next slide, as I mentioned, we'll talk about and showcase one of our important asset management tools that we use. It's a system called OnSite IQ. So OnSite IQ delivers a full immersive 360-degree imagery of our active projects across our entire real estate portfolio. This provides real-time record of progress to date, along with project analysis and actionable insights. And as you can see here, this is effectively the dashboard for this project to show the level of completion across the various disciplines and project milestones by category. So it's a very effective tool for us, for our investment management team, to get real-time insights on project completion. And as our development portfolio continues to grow and expand throughout the country, this is a super efficient way for us to keep tabs on each one of our various projects. On the next slide, I'll talk about the first of our two newest preferred equity investments. The project here that we're focused on is McKinney Falls. McKinney Falls closed in January. The fund is providing an $8 million preferred equity investment alongside Growth Fund 4's common equity investment, and sits at a very attractive loan to project cost basis of 75% of cost. This investment will earn a 13% compound annual IRR. And we'll talk a little bit about one of the very unique aspects of this project, which actually dovetails pretty well into a new prospective build-to-core opportunity that I'll hit on later. But the project itself is a 290-unit, 4-story elevator-served asset located in Southeast Austin. It's about 9 minutes from the Austin airport and 15 minutes from downtown. The compelling aspect is highlighted here on the slide is the what's known as a PFC structure. And I'll spend just a second explaining what that is. But the PFC, which stands for a Public Facilities Corporation, is a Texas state statute that removes the property tax liability from a particular property in exchange for two things. One is a requirement to provide affordable units, and generally speaking, that's roughly that's applied across 50% of the total units in a project. So in this case, being a 290-unit project, we are required to provide affordable units to roughly 145 of the units themselves. Generally speaking, that affordability requirement is spread across some percentage of, as dictated by HUD at the national level for the respective metro that's in this case, this is Austin, based on 60 to 80% of the area median income. So in exchange for this, we have to provide a long-term lease to the Travis County Housing Authority. But this is critically important, not only for this investment, because it removes taxes, which in Texas is roughly 50% of your entire operating expense budget. So it's a huge component of your overall determinant for your NOI for the project. So this removes almost the entire tax liability completely. And I believe the term on this one is 75 years. So it's a 75-year lease with the Travis County Housing Authority. So what this does by removing property taxes from your liability is providing significantly increased distributable cash flow available to service debt, and in this case, service our preferred equity position. So super excited about this one. These are difficult opportunities to find within the Texas marketplace. As you can imagine, this is highly sought after by investors because of the outsized yields that are generated for these types of structures. On the next slide, we'll talk about the other new preferred equity investment that closed right around the same time as McKinney Falls. This project's called Marlo, and similar to McKinney Falls, it was a $9.4 million preferred equity investment alongside a Growth Fund 4 common equity investment. Sits at the same structure in terms, so 75% of cost at a 13% compound annual IRR. This project notably represents our fourth development partnership with industry-leading developer Greystar. And actually, this marks our Origin's first investment into the Las Vegas metro. So we've broken ground on this asset already. It's a 324-unit, 3-story garden project located in West Henderson. So it's about 6 miles south of the Harry Reid International Airport and about 10 miles south part of Las Vegas Strip. So that project, along with McKinney Falls, both are underway on behalf of the fund. As I mentioned on the next slide, we'll talk about expanding our build-to-core portfolio. And I won't spend a tremendous amount of time talking about this project because right now it's still in the infancy stages. We believe it's likely to come our way. But we'll announce this more as we get further into agreement with terms with the development partner, and announce this later. But I wanted to note that this is also similar to the McKinney project that I just mentioned. This is another PFC opportunity in Austin. In this case, this project's located in northeast suburban Austin, not far from Tesla's new Gigafactory and their headquarters. So very similar terms to the PFC that I just outlined for McKinney. So provides for exceptionally attractive distributable cash yields over a long period of time to the investor. The benefit here is that we would actually be the common equity investor and we would enjoy in those higher than market distributable cash yields, unlike our pref position where we don't get to enjoy in the upside, but we're certainly protected and risk is mitigated from our position there. So this will likely be a sidecar opportunity that will bring to existing fund investors, no different than we did with the Linden House project and some of the others that were made available last year. So this is anticipated to close and break ground, and there's still a few hurdles that we have to get through. But in rough timeline right now, it would be September timeline. So if there is a sidecar opportunity, we'll likely be coming back out to our investors here in late summer. So stay tuned on that front. The next slide, as Michael mentioned, I'll spend a little bit of time talking about our pipeline. And this will be a time where I can insert a few comments on the state of the market as well. But we are continuing to remain active in that gap capital that Michael mentioned, which is taking the form of preferred equity investments, because senior lenders have really been reducing their proceed levels to the point where now it's creating a much greater need and opportunity for preferred equity investments. So in addition to the build to core opportunity I just mentioned, which is also part of our pipeline, we have 6 preferred equity investments in our pipeline across really all of our investment regions. There's opportunities in Phoenix. We have some in Austin, central and coastal Florida, and an opportunity here in Charlotte as well. And I'd say, generally speaking, preferred equity rates are holding around the 13 to 14% range. But depending on the location of the asset and the quality of the sponsorship, we're now seeing competitive capital continue to move into the space because a lot of the larger institutions are seeking a very similar protected position that Michael alluded to earlier, which is one of our competitive advantages in how we've structured this fund and the investments we've made over the last couple of years. So the space is getting a little bit more crowded, which is driving down, for again, those high quality location, high quality sponsorship, driving down the IRR pref rates, if you will, in some cases to the 12% range, especially if that leverage level is reduced from, historically the prep positions in the last 2 years would sit between roughly 60 and 65% and call it 85. And now what's happening is those last dollars that are being provided by the senior lenders are now reduced to roughly 50 to 55. In some cases, the last dollar that the preferred equity investment sits in is now at 75 to 80. So if you combine the lower position, risk position in terms of where you're going up to on the cost of the asset, plus the high quality nature of the things I mentioned before, those are definitely in that 12% range. We are remaining on the hunt for acquisition opportunities of pre-stabilized build for rent assets. We very much believe in the long-term fundamentals of this asset class. And we'll talk about a sidecar opportunity that includes a build for rent preferred equity investment opportunity here on the next slide. But we haven't seen yet some of the things that will really remain disciplined in terms of our search for new investment opportunities, especially ones that are acquisition where you're not building to a protected margin per se. And really what we're looking for new investment opportunities. And for those of you who've not been fund investors for the duration of this fund, we have not made a common equity investment since COVID. The last acquisition that we made for this fund was in March of 20, which was represented a deal that we had pursued really in late 2019. So we haven't been active in acquisitions for over 3 years at this point. So we're being very cautious on where we're at in price discovery in the marketplace. And we've underwritten thousands of units worth of build for rent pre-stabilized acquisition opportunities. And we have yet to find that cross section that we're looking for, which is an opportunity that really sits at or potentially even below replacement cost in a location that we think is durable and desirable for the renter, and ultimately has those communal amenities. Because we're seeing right now some opportunities from regional home builders, local home builders that were really just truly, single family homes that were built as part of a larger subdivision, but they don't have the community elements that we look for in a build for rent community, which notably are swimming pool, fitness center, clubhouse, those types of amenities that the residents of those homes or townhomes are used to having and seek out in conventional multifamily, are still looking for that in the build for rent experience. So we haven't found yet that kind of tri-party cross section of elements that we're looking for, but it's early and we'll continue to remain at it. And we believe later in the year, we will find some opportunities on the acquisition side that fit that criteria. So my last slide here will be to highlight our upcoming pref sidecar opportunity. This is actually the first preferred equity sidecar that we've provided to investors here at Origin. Very excited about this one. We are finalizing the deck and the PPM shortly. And if you have additional questions, please reach out to your respective representative here at Origin for more questions and details. But this offering will be provided exclusively to existing IncomePlus Fund investors. And just wanted to note that these investment opportunities will not be included within the fund itself. This is going to be truly a sidecar opportunity. So this is a two-property portfolio provided within the same prep sidecar position. Two ground-up developments, one of which is a build-for-rent asset located here in Charlotte, where I sit, in suburban Matthews. And Matthews is a very affluent suburban community here, high barriers to entry, very difficult to get any entitlements to build conventional multifamily or this type of build for rent. It's a unique opportunity here, the project called Ava Matthews. This is a 160 unit project, and it has three different types of unit and floor plans available to prospective renters. There's the conventional multifamily units here, of which 100 out of the 160 are in what we call the flats units. And then we have some attached townhomes, and we have some for rent single families. So we're truly catering to the entire spectrum of renters, those of which who crave for conventional 3-story living over the common area amenities, those of which who are looking for more of a less dense living experience in a townhome, and certainly those who are looking for their own fenced-in yard and single-family opportunity. The other investment included in this portfolio will be a project called Solis at Casa Grande. That is a 284 unit project located in Casa Grande, Arizona. Casa Grande is roughly 45-minute drive between Phoenix and 30 minutes from Tucson. So it sits in between those two metros, but very much drafts off the fundamentals of Phoenix. Catalysts down here in this particular submarket for growth really are logistics, advanced manufacturing, and to that point, Lucid Motors has recently developed and opened their $700 million EV manufacturing facility. So lots of high-paying manufacturing jobs logistic jobs. And then you also have proximity to the suburban employment centers in South Phoenix Metro. This will be our third project with the sponsorship group, Jackson Dearborn Partners. I failed to mention, but on the AVA project, that is also our third investment partnership with two capital partners out of Atlanta. So definitely a repeat development partners, high quality, well-respected groups in both partnerships. And site work's already commenced on both of these deals. So this represents an opportunity to put capital to work immediately in two of these projects. So again, as I mentioned before, excited to bring this out to our investor base here, and think it'll be pretty well received in the current environment. So with that, Michael, I think that brings us to the end of the presentation. We can open it up to Q&A.
Great. Thanks, Dave. I will take the first question, and maybe you can tee up the next one. First question, can you talk about what conditions would likely need to happen to have you change from your current position of preferred equity deals to the non-preferred, the common equity positions in the fund? Dave talked about this a little bit. I did as well. I'll answer this quickly. And the one big thing in the market is that there's negative carry right now. You have borrowing costs above cap rates. The market will ultimately self-correct. That equation can't last forever. And that could be that rates come down or prices come down, but it's likely a combination of both. The other thing, just being able to buy things at or below what we could build them for would also be one of the metrics we look for in buying these things. So we definitely are, looking all the time, but it's not, the market is just not there for us right now. We're still seeing a disequilibrium and better opportunities in preferred equity and even some of the ground up development deals today that Dave talked about.
Michael, I can take one of the questions that was sent in to us, if you don't mind. One of the questions here was, since occupancy is so important, how do you attract and retain tenants? And it's a great question, and actually one that we did cover a little bit about earlier in the presentation about some of the awards that our investment management team has been recognized for. So reputation management is a very important part of that in terms of attracting tenants. And I kind of talked a little bit before about how the prospective resident goes about on their journey and searching for their future residence. And oftentimes that first step is going on Google and actually reading reviews. So that's why we're again highlighting and touting our performance and recognition on that very important part of our active investment management platform. So that is definitely one way that a tool that we use to attract tenants. And then how do we retain tenants? Well, it's really through great customer service, no different than how we spend a lot of time and energy and effort in serving our investors. We do the same thing on the resident side as well. So we're very actively engaged with our various property management platforms around the country. We ensure that they're taking high quality care of our residents. That again, ranking number 4 for best maintenance. That's a huge component of that as well. When a resident reaches out to you and files a maintenance request for a broken air conditioner or a leaking faucet or a toilet repair, we want to make sure that we're on top of our management teams, tracking their performance in terms of tenant issues, but it's really taking care of your clients and listening to their needs. So those are right now more than ever, those are the two ways that we're using technology and we're using great service to attract and retain tenants.
The playbook the investment management team has created is impressive, to say the least. It's about, I don't even know where it is today. I know it was 70 pages at one time. I think it's always growing. Dave, I'm going to grab 2 questions just in the interest of time. How are the preferred securities taxed from a tax perspective? Why were there no taxes due in 2022 per the K1? And the reason is our preferred equity is really common equity in a priority position. So this is the way this is documented. So we're not actually taxed on any accruals that you would in a typical preferred equity or maybe even mezzanine debt, where you have to recognize that income on an annual basis. And our typical preferred equity, it doesn't actually have a maturity. There are put rights and things like that in terms. So we've done this so that it operates more like common equity. And it's also a way for us, when that preferred equity gets paid off, we are actually generating long-term capital gains. So tax efficiency is one of the main tenets of this fund, and that's something that we do and think about in everything, and including the preferred equity, because certainly the more you are tilting the fund towards an asset class that is less tax efficient, the less tax efficient the whole fund is going to become. So it's not that the tax or the fund is tax inefficient, it's as tax efficient as it possibly can be given the makeup of the fund. Next question: how do investors true up with existing money in the fund? There is no true up. You're actually just buying right into the value of the existing assets, and that it's different than a closed-ended fund. In an open-ended fund, you can actually invest all of your capital at one time, and you're diversified across the existing assets at the current valuation that we've made, and that's why we come up with a monthly net asset value and equate that on a per unit basis as well. Dave?
Yeah, I think we can take two questions on REIT investments, on our public REIT investments, and roll them into one. I can handle the why. Michael, if you want to handle the how they're doing and do we plan to sell or buy more. So the reason why we're investing in public REITs right now is a lot of what I mentioned earlier about we're still in the early innings of price discovery in the private market, and we're still seeing pretty aggressive valuations on a relative basis to the public markets. So cap rates in our markets still are, roughly in the low 4 to mid 4 range. From what we're seeing on observed trades and our underwriting. So still, really haven't seen a lot of fall off in the types of assets that we would be looking to acquire. And frankly, the types of assets that these public REITs own. So what's interesting is there's been a dislocation between private market values and public market values. And the public REITs have been hovering around implied cap rates of the 6% range for a while. So there is a disconnect. And while we wait for price discovery to happen in the public or the private markets, we view these investments in the public markets at a 6 as a pretty attractive position.
Yeah, I said this in the beginning. I mean, our job is to allocate capital to the best risk-adjusted opportunities. And one of the strategies in this fund is allocating to common equity. And when you're in the private markets and you have this information and you look at the public markets, which we also have a lot of experience on that side, and you do the analysis, you're like, look, we're trying to buy 4.5 caps over here, but it's actually trading above a 6% cap rate on this side. And when you just look at the price by itself, the public REITs are trading, the multifamily public REITs is what we follow and what we're invested in here. They're trading at 2019 levels, and we'd all love to have a Wayback Machine and go back and buy multifamily real estate at 2019 levels, because it's appreciated significantly over that time. And yet you can still do this in the public markets because they are dislocated, and the public markets don't always do a great job of valuing real estate. And we think that there's a dislocation and there's asymmetric upside. Are we going to add to the public real estate portfolio right now? No. And there's another question about the sidecar opportunity and why this isn't going into the fund. And really, I'll answer these in the same way, but we only have about a 4% allocation to public REITs, and then we're sitting on some cash right now. Some of that cash is reserved for other opportunities that we see coming down the pipeline, the one that Dave talked about in the pipeline especially. So, running a fund is a lot about managing cash, making sure we can meet our liabilities of paying the distribution yield, also having money to fund obligations of our existing ground up development deals, and then retilting the portfolio in direction. So the fund has plenty of preferred equity in it right now, and we would rather see that money go into the ground up development opportunity that we have right now. So if you do the math, 6% of the fund is in cash. That's about $24 million. And we actually like having some cash as a reserve in the fund, just as a as a cushion, if you will, for the unknown out there. So that's kind of how we're running that. But we're not planning on allocating more to REITs. We're very happy with the prices that we paid, and if we saw opportunities on the private side, then we would probably trade out of those public REITs and get into something on the private side as well.
Let's see. I've got a couple questions on market fundamentals. I think I answered this before, but what are you looking for in terms of fundamentals to get active on the acquisition front? What would make a deal compelling? Michael, you touched on that as well, but it's really the intersection of the things that I mentioned, right? Which is in terms of basis relative to replacement costs, locations that we believe are desirable and durable, and then ultimately producing a compelling yield as well. We're looking for opportunities that frankly aren't at negative leverage. So our cap rate exceeds or is equal to the borrowing rate. So once we find those three opportunities that intersect, that's what will make a good acquisition for us.
This is from Anonymous. A couple of ground up developments had sidecars associated with them, with the expected stabilization values being below pro forma. Will the minimum sidecar net equity multiple still be able to pay? The answer is yes to that, because if you look at where we've written them down, they're still well above that. And that minimum equity multiple, I believe, is after 2 years. So we have a long way to go before we get to that point in time, and we'll continue to update you. But that was really for your benefit, that minimum equity multiple. So if the market did actually slide, that we wouldn't be buying these back from cost, and we can continue to hold them. But certainly, if the market is in a condition where we didn't meet that net equity multiple and that lower threshold, we still might make a tender offer, and then it would be up to you. But I think if we're above that mark, then the fund has the right to actually acquire those units at fair market value. I believe that's the way it's worded.
Zach asked a question: are you managing cash strategically while it sits, short-term T-bills or anything of the like? Absolutely. We're doing that across all of our funds. I think our current rate, Michael, that we're getting on our cash positions is north of 4%. Is that correct?
Oh, it's in excess of that. I think we're at 4.8% now. Yeah. And if you, Dave Shearer, partner, just did a great interview with Sheila Bear, and they talked about that. So we've done a lot of cash management, making sure everything's secure. We're in the IntraFi program through Wintrust, and we have many millions of deposits, well and over excess of FDIC. But we've been on this for some time, and I would highly recommend you go to our website and watch that interview. She's fantastic, and Dave did a great job there. All right, go ahead, Dave.
Anything else, Mike? Yeah, I was going to say there's a question about the sidecar opportunities being tax efficient. I think that the answer to that is yes. We're making every intention to make those similar to our prior sidecars, where there will be some tax efficiencies and conversion of into IncomePlus. But if there's any additional insights there, Michael, please go ahead and share.
No, I kind of touched on that, how we're structuring these as common equity in a priority position. Gary, I think I asked you your question. Do you still accrue income on the preferreds that are in red? The answer is no to that. I'm happy to send you the valuation policy if you want to see that. That's quite extensive. Jeffrey asked the question: will you ever move into 1031 exchange opportunities? The answer is yes. This is actually on the table, something we've been discussing quite a bit lately. We're perfectly positioned. All of our investors are taxable. We get asked this question on a daily basis practically, and I think we're positioned to be able to deliver a great product to the market. So this is on the drawing board, and certainly if you have a 1031 exchange opportunity, just reach out to us and we'll see if we can do sort of a reverse search, see what we have in the pipeline, see what opportunities we can structure for you, because we can always do this in kind of a reverse, demand situation.
Question from Thomas on the preferred equity positions. Do we have the ability to take over a property if it gets into trouble? Thomas, yes, we do legally within our venture documents. Happy to get into that in more detail later, but simply put, there's various default provisions that if a developer or sponsor gets into trouble and reaches those default positions, then we have the legal right to step in and cure the defaults and potentially work with the lender to take over the project. So we do have those protections built into our preferred equity investment structures.
Next question, will you and David be participating in the sidecar deals? The answer is yes to that. I'll grab another question. Do you anticipate a reasonable probability of writing NAV per share or just growing it slower? At this point in time, we're evaluating this each and every month. So you saw the makeup of the portfolio. Obviously, the cash isn't going to move. The REIT shares are moving on a monthly basis. So I can't opine. I kind of showed you the slope on the development deals based on where we're evaluating them today. There's still a markup of those assets from where we currently sit to that $92 million slope. I don't anticipate writing it up or down. Our goal is to generate a 9 to 11% annualized return, sort of within a tight range of distributions. I think the webinar I did about 6 months ago, I kind of broke down like how this fund is designed sort of on a downside of 5% and an upside of around 15% per year. Of course, I mean, we're going to have negative months along the way. I think, the way we've positioned this fund, it's in a great position today, especially if we see some opportunities in the future. But I think that, kind of that 5 to 15% range on an annual basis is what you can expect.
Question about, will we do value add at some point or just target primarily core plus? This fund, one of the many benefits of this fund, certainly from my perspective in going out to the marketplace and sourcing, is that we can do a lot of different things. I do kind of call this fund our Swiss Army fund. We can do pref, we can do build the core, we can make common equity investments, and a subset of that is value add. Although I don't anticipate many of those types of opportunities, because oftentimes those value adds are older vintage funds or older vintage assets, and we're looking for generally newer opportunities. But if values fall in newer vintage assets and there is an opportunity to complete some value add, we will absolutely pursue.
So Anonymous asked this about providing preferred equity across our various funds or investing, and we actually do that. So the IncomePlus Fund provides preferred equity to the growth fund. And so the growth fund is a higher leveraged fund opportunity. It's more of an opportunistic fund that engages purely in ground up development. And the target leverage in that fund is around 75%. And the real reason for that is we wanted to significantly differentiate that risk return profile from the IncomePlus Fund. And so leverage was one of the ways we did that. And when you can only get 65% leverage from banks, that fund tops out at 75%. And it's the IncomePlus Fund that is providing the majority of the preferred equity to that fund at up to 75% level.
Robert mentioned that he's in 2 other funds, and one is stop distributions without providing an explanation. And then another one said that they'll reevaluate in the 4th quarter due to floating rate risk. Is this fund also at risk? I'm assuming that's in terms of risk of stopping or withholding distributions. And the answer to that is no.
Dave, I think we're kind of over here by about 11 minutes. We've had a lot of great questions. So let's sign us off now. Thank you, everybody, for your questions, for hanging in here for an hour and 10 minutes. I know we got started maybe a couple minutes late. We're dealing with some things on our side, but we really appreciate your partnership at Origin. If you're considering an investment, please reach out you can go to the website and find us there. You can download any of our documents. You can email investorrelations@origininvestments.com. You can email me, Michael, at origininvestments.com. We make it super easy to get in touch with us. So thank you. We really appreciate your time today. And thanks, Dave. It's always great to do webinars with you.
Likewise. Thanks, Michael. See y'all.
All right. Take care.